At this time, I would like to introduce Tom Blaney, co-partner in charge of the private foundation practice with PKF O'Connor Davies. Tom?
And I would like to thank a couple of our guests and really our partners. Philanthropy New York helped make us generate this program. We worked hand in hand with that. And also especially John Tyler from the Kaufman Foundation. John is general counsel out there, and John and I have probably spoke maybe together almost a dozen times over the years. We're going to start dating ourselves, how old we are, on various self-dealing issues and various 990PF issues over the years. I know this is tax and it could be somewhat boring, but we're going to try and entertain you the best we can. We're going to try and make it so-called a sexy topic if that's possible. We encourage any type of audience questions throughout, especially on those particular pages. And as long as we're within the appropriate time frame, we'll answer those questions. If we run behind, we'll leave those questions towards the back. As Holly said, this is eligible for 3 CPE credits in taxation. And so saying that, why don't we start off and get rid of one of the polling questions right away? So the first polling question is question number 1. Do you find the history of the Form 990PF and private foundations interesting? Yes, of course, or I'm a private foundation history buff. So everybody just wants to give that a shot, and then we'll go from there. So maybe before we actually get into the form itself, I thought I'd go through a little history of the form and how it evolved and why it evolved. And believe it or not, it goes back to 1961 when there was a congressman from Texas, a gentleman named Wright Patman, that actually had it in for so-called charities that had endowments. We now call them private foundations, and I'm going to get to that in a little while. But he attacked large foundations, small foundations. He really went after, in particular, 2 types. The large foundations, he attacked the Ford Foundation, and he attacked smaller foundations that were associated with family businesses. And one of the ones that made the papers back then, and somewhat today with the political climate we're in, he was attacking Robert Kennedy and Kennedy's staff, where apparently they put about $131,000 of staff time charged to a not-for-profit organization. And he was really going after the IRS. He said the IRS really was not enforcing these type of organizations. And he really was really probably almost for an 8-year period, him and his committee finally got some results. And when they actually had hearings on private, so-called private foundation abuses. And that started in February 1969, the year the Mets won the World Series. What ended up happening by the end of the year, December 30th, President Nixon actually signed what we now know as the Tax Reform Act of 1969. As that relates to not-for-profits and private foundations, there was really 4 attributes that really keyed in and initiated the private foundation community. 1, the term private foundation was established. So that was the first time officially these nonprofits that gave out money, that had endowments, were classified as private foundations. The next item that was established, it was a 4% tax on net investment income. And the purpose of that 4% tax, which currently is 1.39%, which we'll get to in a minute, was really to fund IRS audits within the private foundation community. What they wanted to do back then is guarantee all large foundations, and they never technically defined a large foundation, but speaking to somebody that was involved in the 69 Reform Act years ago, they classified any foundation with over 500 million as a large foundation. And what the IRS wanted to do was basically at that time is audit them every other year. And then for all other foundations, they wanted to guarantee that every other foundation in the universe was audited at least once every 5 years. At the same time, today, we'll get to in a few minutes, how we have this 5% distribution rule. Initially, that was a 6% distribution rule. And then finally, the other fourth aspect is which John Tyler is an expert on, is what I always use the word, these antiquated self-dealing rules really kicked in. They kicked in just for private foundations, not for public charities. And to this date, they really have not been changed. Something of interest within the hearings and the legislation going back and forth, there was consideration of a 40-year 40 term limit for private foundations. And Al Gore Sr., I don't know if for you folks that remember Clinton Gore, president and vice president, this was Al Gore Jr.'s dad. He proposed that. And that never actually made it to the final version. But fast forward to the last few years, different proposed legislation that's out there that never passed had somewhat of a sunsetting term in there. I think 25 years the ACE Act had in there. So that's just a little point of whatever, a little tidbit on that. So the federal excise tax on net investment income, I mentioned it initially, it was 4%. Then what ended up happening is basically almost 10 years later, Senate Finance Committee, IRS found out there really wasn't a lot of bad apples in the private foundation community. It was just really a few isolated ones. So the feeling was, let's reduce that tax to actually 2%. Because remember, back then, all the money that came in went into a pot and just paid for IRS oversight, IRS audits. Then going a little bit further, probably about 6-7 years later, in 1984, they said, why don't we try to get foundations to be more programmatic, to give out money? So there was a formula back then on the 990 PF that lasted about 16, 17 years that basically said, if you gave out more money in grants and grant-related expenses in the current year than you did in your average 5 years, you could actually reduce that tax from 2% to 1%. Then lastly, and it seems like yesterday, but 4 years ago, there was a lot of talk and proposals, and finally a flat tax came into play, a 1.39% flat tax. And just a little side note for whatever it's worth, we've always found over the years that the foundations that had good tax planning within their organization qualified for that 1% tax, especially in those years when they had significant capital gains. So believe it or not, I think the flat tax, in my opinion at least, actually hurt the foundations, small or large, that did significant tax planning on the 1% requirement. But it's something that's done. It's been, and now we have the 1.39% tax. And that tax, when I say investment income, is based upon interest income, dividend income, and in 9 out of 10 cases, realized capital gains will be the largest component of that tax. And we're going to go over a little bit of that in a couple of minutes when we actually go through a PF. Then really, I'm just going to fly through this. And I mentioned there was a 6% minimum distribution. Then that actually, over the years, got reduced to 5%. And what do we say with the 5% distribution? Is basically you have to give out by the following year 5% of what's called your non-charitable use assets, which is a fancy name for your cash and your investments. And when we get to pages 8 and 9, we're going to go over that, and we'll go over that in a little bit of detail, how it's calculated, what periods are used, etc. So I thought now we could just spend a little time going through initially page 1 of the PF, of the 990 PF. And a few things, as I mentioned, wherever we can, we're going to give a little tidbits and maybe some what we call common errors that we see out there for the first time that we look at a PF. I'm going to say by far the probably number one website most folks are using today to look at whether it's a 990 of a charity or a 990 PF of a private foundation is ProPublica. Right up next to it is probably Candid, which is the old name for GuideStar, and they merged in with the Foundation Center. Both websites basically will call up if you just put in the name of a foundation or a charity through the search engine, you see both of them pop up automatically. So as I've always said, as we all know, these are public documents. So if you're a preparer, you want to make sure that it's errorless, all the I's are dotted, the T's are crossed. There are many organizations. I know a few years ago, the number one organization, I won't mention the name, but it was basically the number 1, 2, and 3 user of the old GuideStar was investment firms, because they're looking to see what investments a private foundation has, and also probably looking at the investment fees. And so if they want to solicit a potential charity or a foundation. So the first item, I just want to zoom in there. If we look at, we have the name, and in this particular foundation, they actually have a place of business. So what we recommend, if you don't have an office, do not use your home address up here. Use what we call a gatekeeper's address, whether it's your accountants or your lawyers. We've seen over the years where, I'm from Brooklyn, so I'm going to say from Brooklynese, you don't want some nut showing up at your house because you turned them down in a grant, or you gave a grant to a particular charity that was not well liked by this individual. And we've seen that happen probably a handful of times over the years, and it got very ugly. So that's one thing. The IRS accepts what's called a preferred address. So there's actually 4 places within the whole return, such when you list the name of the offices, etc., where you do not have to use a home or even a business address. If you're a small entity, you can, again, use the gatekeeper's address, which is the accountants or the lawyers. The other item I wanted to mention here, if you look over there, there's the name change. So if you change your name during the year, right here to notify the IRS, or an address change, you make sure you check those boxes, and then attach the official approval of the name change or the address change, some type of document with the return. Going down there, box I. Box I is the fair market value at the end of the year. Sometimes people don't realize where that is, but it's an important box to see the value of the foundation. This box must also agree to box 16C on page 2. I don't want to get geeky here with parts and section numbers, but I thought it would be a good check. So if you're ever looking at a foundation and those numbers don't agree, then you know something's wrong, or there could be an issue there. In a few minutes, Lauren is going to go through the balance sheet, and box 16C is total assets on there. Then last but not least, when you look at accounting method, if somebody came to us and they're a starter-up foundation, we would strongly recommend that the foundation utilizes what's called a modified cash basis. And why are we saying that? I think from management's point of view, we like to keep everything simple and clean. We're not General Motors or Google or Apple here. We find that the best type of books that can be maintained is a simple set of books. And when we go through the PF, you're going to see a lot of ratios are based on a cash basis or a modified cash basis. A foundation most directors of a foundation really don't care about deferred taxes, prepaid expenses. What does a typical trustee director want to know? What's the fair market value of our investments? How much cash do we have in our bank? How much grants did we give out for the year? How much do we have to give out in the future? And all of those, all you really need for that is the modified cash basis. I know we have one nice client out of Minneapolis. They actually had, when we first got involved, they had 3 different bases. They had an accrual basis for the audit. They had a modified cash basis for the tax return, and then they had a cash basis for their actual books and ledger. So it was very difficult for the accountants there, the controller, to put everything together for us to do the audit on one basis and then to do the return on another basis. So we worked with them in the first year. We converted all 3 sets of books into one, a modified cash basis, and everybody from management to the board appreciated that and liked that a lot better. Moving on. We got poll question number 2. What type of accounting method is used to prepare your federal Form 990 PF? Cash, accrual, modified cash, or other? And I should mention Um, Here up in the Northeast, again, modified cash is accepted by all the AG's offices, etc. Our friends in California, if there are significant contributions for the year, they require an audit be attached to the PF, and that audit they require on an accrual basis. And I know one of our accounting firms that's a competitor, but a friend, Fontanello, Ataki, and Duffield, out in California. They more would in that particular state would recommend the accrual basis. Then Mike Fontanello and I would always have friendly arguments on that, how we feel we're just making it more difficult for your clientele. Your clients. Unfortunately, if you're a good sized foundation and you've always been on the accrual basis, you're somewhat stuck unless you really apply for a change of basis. And a lot of times it's not worth it. Folks are used to the accrual basis, and you have ample staff to maintain the two different sets of books for the PF as well as the audit. Then just moving on, another little tidbit over here is on the income statement. So I should start off by saying, normally with a typical foundation, most columns that are used is column A, B, and D. And we're going to get into column C in a second as well. Column A is your P&L for the year. So if you had an audit, with the exception of maybe any unrealized gains that are later reflected in part 3, those numbers will mirror your audited financial statement. Column B, that's what you're going to pay your tax on at the end of the day. That bottom line, when we get to the next page, that's going to be subject to the 1.39% tax. Column D, these are the numbers that are right there. It says cash basis. These are the numbers that count as your qualifying distributions. It counts towards your 5% requirement. So it's really the largest number will be grants in almost all cases, and then all your other, what we call qualifying distributions, grant-related expenses. When you're on a modified cash basis, normally, and we'll get to this on the next page, well, maybe I'll save that comment for the next page so we don't confuse people. But this is the income statement. We had one, I'm going to say minor tweak, or actually an error. When we get to column C, that $10,725, they have program-related interest in there, program-related investment interest. And what has happened starting in 1986 on an act called the Pension Reform Act, PRI interest, program-related interest, now is taxable interest. So that really number should go in column B. And I'm going to get to that in a minute as well. So here's the other income. And here you can see that $2,500 that we have in C. That really should go in column B, because that's part of your net investment income for all returns prepared after 1987. Before that, it would be the same way that it's structured here. When we have any what we call, and we'll be going over this a little bit later too, direct charitable activities, where we're actually involved in putting on seminars or doing research for organizations, if we generate any revenue that come in, that's not taxable. And that's what's really reflected in column C in our adjusted income. On the expense side, when we get to the expense section, a few things and a couple tidbits too. Normally, when we're on a modified cash basis or a cash basis, column B plus column D will equal column A. Now, there are a few exceptions. I use the word normally. Number one, when you look at taxes, one item in column A is your federal excise tax, what we actually pay on our tax and net investment income. That is not allowed to be allocated to column B or column D. So many times we'll pick up a new client and we'll see the federal excise tax is allocated to either B or D, or sometimes even both. And that's what we call, it's a mistake, and that has to be adjusted, and that cannot be taken into place in the future. If you're on an accrual basis, B and D, total of B plus D, may not add up to the column A, because you might have certain items in accounts payable that have to be netted against between last year and this year. Also, if you file a 990T, A 990T is basically a tax when you have a foundation that generated unrelated business income. There's a good chance some of the expenses to generate that UBI, we're going to offset that UBI income and take that on the 990T, and therefore will not be taken into place here. The only other item that's really not allocated to B and D if you're on the accrual basis is depreciation. Depreciation is not allocated. And the reason for that is when you actually purchase the asset, as we're going to see later on pages 8 and 9, it counts as a qualifying distribution as long as it's a program, it's a qualifying distribution type of asset, i.e. a computer for your program people or a desk for your office, or maybe even a new building for your operations. So we just wanted to mention that. Going into statement 2, something when you have legal expenses, we always like to dive into the invoices or ask management to dive into the invoices, because legal expenses can be both programmatic as well as investment related. So it's programmatic when you're just hiring your attorneys to review leases, or maybe putting in a DEI program, or maybe unfortunately terminating an employee and you incur lease expenses. Then that will count towards column D. However, if you use your lawyers to establish an investment policy or to review any type of investment documents, then technically those legal expenses can and should be allocated to column B. Next item is something that we learned a few years ago when Andrew Schultz, who was at the time was in-house counsel of the Council on Foundations, and talking to agents, and it was actually a ruling back there. It says any accounting fees, whether it's fees that charged for the audit or tax preparation, they really should count as an administrative expense, or more or less towards column D as a charitable distribution. The only type of items that would possibly count on net investment income with accounting fees, if they ask the accountants to actually look at investment documents to decide whether the foundation board is going to buy or not buy a particular investment, maybe say an alternative investment, something like that. Statement 4, again, I'm not going to go line by line item, but I wanted to mention this again. This foundation in particular goes above and beyond than just writing a check for a grant. They actually have boots on the ground. What do I mean by that? In the example, they might send out some of their employees to the grantee to actually help them with research, or actually help them set up for a conference. So we called it here grant making advisory services, and those expenses are going to column D. Every investment related expense goes to investment, whether it's custodial charges, investment management fees, any type of fee whatsoever, and they are actually a deduction from your net investment income, as you see the 462 number right there. Then just following a little bit below in the taxes, as I mentioned, in this case here, the $80,000 on the federal excise tax, that's not allocated. And what you see out there many times, if you're using a big investment advisor, they will go back and try to get a credit or try and get a refund of certain foreign taxes that were charged in connection with dividends paid. And when that money comes back in, that's allowed to be an offsetting expense against your net investment income. And then we have other expenses that the majority of other expenses, again, unless the word investment there, is almost always allocated to column D. Now, you might see a little bit there on expenses in connection with your seminars. And then again, these are for foundations that perform what we call direct charitable activities. We had some seminar income come in, so that's why we offset that against the seminar expenses. There was a ruling years ago when there's a line item here, it says insurance expense. And basically that ruling, and John might even touch base on it in self-dealing, that says if a foundation goes out and buys director and officers liability insurance to protect the offices, it's no form of self-dealing. It's actually acceptable. It's very common. And those expenses that you would go out and pay for those premiums, they actually count towards your 5%. And that's why they're in column D. We have another polling question. CPE question number 3. What are your foundation's largest expense? Are they grants? Are they salaries or compensation? Or is it rent, occupancy? Now, saying all that, I'm going to hand this over to Lauren. And Lauren's going to go through the balance sheet and certain other criteria. Lauren, thank you.
Thank you, Tom, for kicking us off. Hello, everyone. Happy to see so many members joining us today, especially during lunchtime, no less. I will now walk us through page 2 and 3 of the return. As you see here, page 2, part 2 is your balance sheet. The first page of part 2 highlights all of your assets. And it's important to note here that column A and column B does reflect the value on your books, with the first column being the book value at the beginning of the year, and the second column is your ending balance. These 2 columns should mirror your books and records based on your method of accounting. We saw earlier that this example is based on the modified cash basis of accounting. However, column C must be reported at that fair market value, regardless of your accounting method used. Now I'll walk us through some of the various line items here. And as Tom said earlier, touching on all the key notes for each and any common errors that we have seen historically and to watch for. And again, this section essentially mirrors your financial statements, but with a bit more detail. For example, on line 1 and line 2 here, cash needs does need to be disclosed by non-interest bearing or interest bearing, such as your savings and temporary cash investments. Lines 3 to 7, those reflect any type of receivables that the foundation would have, such as accounts receivable, pledge receivable, notes or loans receivable, due, and also any grants receivable and receivables due from officers, directors, trustees, and other disqualified persons. That last receivable is shown on line 6, and similarly, which we'll see on line 20, over the next few slides over in the liability section. These 2 lines are where the foundation would disclose any amounts due to or from a disqualified person, such as that officer, director, or trustee. And this is especially important to note as this may be related to those self-dealing type transactions, which will be discussed later on in the presentation in more detail, as John will take us through a deep dive in the rules on those. Further down in the assets section, you will see various lines regarding your type of investments. Line 10 and B, line 10A, B, and C disclose the various type of investments, whether in U.S. and state government obligations, corporate stock, or corporate bonds. And line 13, those are your other investments valued at NAV, such as your private equities or hedge funds, which all of these are pretty standard types of investments that a private foundation could have. And again, it is important to note here, which we will also see mentioned when we get to the common pitfalls section, part of the presentation, that private foundations are required to disclose every investment. So these can no longer be summarized, nor can a PDF document be attached, since as of a few years ago, the return needs to be electronically filed. So we will see all this detail presented over the next few slides as additional statements to the return. Line 14, that presents any amounts for land, buildings, or equipment, less the related accumulated depreciation on those assets. Line 15 reflects any other types of assets, such as book copyrights, which we'll see in the example statement provided, or program-related investments, which Mike will discuss in more detail later on in the presentation. But more and more, we have seen private foundation engaging in other types of non-traditional assets, such as artwork for those artist endowed foundations and any foundations that have been receiving gifts of art as well. So those are all examples of the type of assets that can be reflected here. And lastly, line 16 totals all the assets displayed above that we discussed. So I'm going to quickly flip through the next few slides, as these are those statements I mentioned earlier that has the additional detail required for each type of investment or other asset. And these can be formatted from a spreadsheet to easily import into the tax software as well. And we have another polling question here, number 4. Does your foundation have alternative investments such as limited partnership, private equity funds, etc.? Yes or no? All right, so now we're into the liabilities and net assets section of page 2. So still your balance sheet. The top part here is your liability section, and similar to why the receivables and prepaid lines in the assets section were blank is because this is an example of a tax return for a foundation on that modified cash basis of accounting, as Tom mentioned earlier. Which to quickly define here is part cash basis to record expenses when paid and revenue when received, but also modified in certain areas such as the capitalization of assets or reporting of investments at fair value. And for foundations on that accrual basis of accounting, you would see liabilities listed here, such as accounts payable or accrued expenses, any grants payable, which is typically that largest liability for a foundation. Line 22, other liabilities, could be any tax-related liabilities, or more recently, since the lease standard implementation, you would see the lease payables reflected here as well. And then the next section is your net assets or fund balance section. Not much to go over here. Just wanted to point out another common error we have seen is the first box remaining unchecked. This box should always be checked for any foundation that does follow FASB ASC 958, which is the net assets classification between that with and without donor restriction. All right, now part 3 of page 2 is your analysis of changes in net assets or fund balance. You'll see line 1 is your total net assets or fund balance, and that's pulled directly from part 2, column A of your balance sheet, representing your beginning net assets, which must agree with the year-end amount reported on any prior year return or any financial statements, either audited, reviewed, or internally prepared. Line 2 is your total net income, which agrees back to the figure on page 1, column A of your income statement. And lines 3 and 5 are other increases or decreases in net assets, such as your unrealized gains or losses on investments, any changes in deferred excise tax, or any prior period adjustments. And lastly, line 6 is your total net assets or fund balance amount for the year, which again should agree to any sort of year-end financial statements that the foundation may have. Okay, next we'll look at page 3 of the return, which highlights part 4 and part 5, part 4 being the capital gains and losses for tax on investment income. And the first line here, line 1A, publicly traded securities can now just be shown as one line in total. Years ago, you needed to list each individual sale of publicly traded securities, so that is no longer required. And it is still the foundation's responsibility to maintain those books and records to support these totals. If the IRS were to ever ask, but again, no longer required to list each individual sale or related detail by date acquired, sold, sale price, cost basis, or resulting gain and loss. However, the gain or loss for any type of other investment needs to be individually listed, such as from a limited partnership. And you will see this example here. We have the capital gains dividends are listed separately as well. The total of this activity is reflected back in line 2 as a capital gain or loss, which should match part 1, line 7, column B of the income statement. And again, important to note that if there was a loss, the amount on part 1 would be 0, as you cannot have a negative amount reported on that line within the net investment income column. All right, and now we have part 5 of the return, calculating your excise tax based on investment income, which some may argue is the most important section since it does show your total tax owed or overpayment that can either be refunded or applied to next year. And as mentioned earlier, a result from the Tax Cuts and Jobs Act a few years ago changed that percentage of the excise tax to a flat 1.39% of the net investment income. So no more fun calculations, unfortunately, to determine whether you qualify for that 1 or 2% tax amount. Line 6 does show all related credits or payments to net against the tax amount, such as your estimated payments made throughout the year, any prior year overpayments or extension payments made. Line 8, here you'll see the references form 2220, which is particularly important for large foundations, which for the IRS for this purpose is any foundation that had more than 1 million in net investment income over the prior 3 years preceding the current year return. So if you are considered a large foundation, the IRS basically wants you to make payments throughout the year, meaning those quarterly estimated payments may be required based on your calculation of net investment income. And this line does show the calculation of any penalty for underpayment of estimated tax. So again, it's important that the books and records are up to date and that these payments are made timely throughout the year to avoid any penalties. Line 9 shows the amount of tax due within the return, if any, and that payment is also required to be paid electronically as well. And line 10, this shows any overpayment, which can be refunded, but we typically recommend applying as a credit to your next year estimated tax, which is how you see presented in this example here on line 11, as this could help your foundation stay ahead rather than playing catch up in tax payments later on. All right, so with that, I will now turn it over to Mike, who will walk us through the next part of the return.
Great, thank you, Lauren. So the next part of the PF really deals with what we call compliance questions. Kind of telling the IRS what's new, what have we done in the past year, and really disclosing what was done. The first question relates to any payments made to influence any national, local, or state election or political campaign. A lot of these times it can be done. It just has to be fully disclosed, and there might be some tax effects on it. If you look at 1C, there's also a separate form called a Form 120 poll, which has to be completed and submitted to the IRS. So it is permissible. It's just there has to be a lot of disclosure, and there might be some amounts that have to be paid to cover it. Question 2 really relates to any activities that haven't previously been reported to the IRS. So when a private foundation is initially set up, they file their what's called a Form 1023, which is an application for exemption, which lists out all the good stuff the foundation is going to do and partake in. But let's say the foundation opens up an LLC to own a property, or they just do a program that's not related to what they told the IRS originally. Perfectly fine. It just the IRS needs to know in a paragraph just explaining the reasoning and what is going to occur needs to be included with the 990 PF. Question 3 kind of relates to any changes made during the year. I know foundations are always changing their bylaws, making amendments to the articles of incorporation or similar documents. Perfectly fine. These documents just have to be attached to the Form 990 PF, what's called a conform copy, which includes a signature by an authorized signer saying, hey, these are the changes that we made during the year. It was voted on and we're happy with them. Just letting the IRS know these are the changes that were made. So kind of more of a, as I said earlier, compliance issue. Question 4. Did the foundation generate unrelated business income tax of $1,000 or more during the year? And the key point here is gross $1,000, so not net. Did the foundation generate a gross income of $1,000? And then if so, did they file the Form 990T, which is a separate federal filing in and of itself with the IRS? Question 5 has to do with the IRS wants to know if there's any, substantial changes to the structure of the foundation. Were there liquidation, termination? Was there a dissolution? Any substantial contraction, substantial contraction is considered anything over 25% of the foundation. Let's say the foundation gives out a massive grant, a legacy grant that knocks the net assets of the foundation down by over 25%. The IRS kind of wants to know about that. One caveat of this, if your foundation lost investment performance by over 25% or not, that does not need to be reported. It's only if it's something structural that was kind of out of that was within the foundation's control, does it need to be reported. Question 6 relates to section 508E, which pretty much ensures that certain language is included in the foundation's formation documents. One of the main points is that it specifically says in the documents that the foundation will, in fact, not engage in self-dealing, will act in the interest of not doing that, and will do everything in its power to not what we call run into penalizing excise taxes. So those questions kind of mark off. Yes, we have those things in the document, and also in any state requirements that are included to be in those documents are in fact included. So you would answer 6 or 7 yes if those requirements are required and you have done it. You answer 6 or 7 yes. Sorry, question 6. And then question 7 is a straightforward question. Does the foundation have at least $5,000 in assets during the year? And then one of my colleagues will cover that later on in the presentation. Just a couple additional questions will drive that. Moving on to the next slide. Again, more compliance questions. Question 8A, which states are the foundation required to report and which are they registered in? Typically, it's your state of incorporation or formation you would list there. In this case, it's New York. But let's say the foundation, for whatever reason, wanted to solicit funds from other states, depending on those states' reporting requirements. Those states would have to be listed here. And then in question 8B, the question rises, did you report to these states? Did you furnish them a copy of the 990-PF to the appropriate either Attorney General or State Secretary of State, depending on the state? Question 9, is the foundation claiming status as a private operating foundation? Again, this would be something that would be decided at the time the foundation files for exemption via its Form 1023. By clicking this box, it generates questions further along in the form, which one of my colleagues will highlight. Question 10. Did any person become a substantial contributor during the year? What this means is did somebody during the year contribute more than 2% of the total lifetime contributions to the foundation, or over $5,000? And again, this could be somebody just donating. They kind of want to know if there's more, because there's special rules related to substantial contributors. So the IRS wants to know if there's new individuals that fall into that class on a yearly basis. Number 12, did the foundation make a donor distribution to a donor advised fund over which it has advisory privileges? This is a hot topic in the industry, as many of you are probably aware. This question is pretty much just saying, yes, we did make a donor advised contribution. It's perfectly permissible, but there are additional disclosures regarding who has control over the funds and what the plan is to distribute those funds once they're sitting in the donor advised fund. Question 13, did the foundation comply with public inspection requirements? Normally this is satisfied just by filing the return. The IRS will put the tax return on its website, and then various sites like GuideStar, ProPublica will post these as well. So we almost always see that answer, yes. And then some further disclosure regarding some internal items. Does the foundation have a website? In this case, it's NA, but a lot of foundations, that's another public-facing platform. So they like to have a full-blown foundation. In those cases, we'll not foundation, a website. They'll post the website here so people can go see all the good stuff the foundation is partaking in. And then the foundation wants to know who's actually in the books and care. So that information is listed here. About 50% of the time, it's the foundation itself, the CFO or the accounting department. Other times, an outside bookkeeper or CFO solutions firm will handle those books, and then their information will be listed in this section. Question 15, regarding non-exempt charitable trusts. Again, don't want to get too geeky, but this is a special type of foundation where they file a form 1041 in in lieu of a traditional form 990. Excuse me. And then the final question: at any time during the year, did the foundation have a signature authority over any foreign bank account? And depending on the thresholds and what country it's in, a FinCEN form 114 would have to be completed, just disclosing that we had the foundation has funded those accounts, and just the IRS likes to know. I believe that the threshold is $10,000 at any point during the year. So, yeah. Okay. At this point, I'm going to hand it off to our distinguished guest, John Tyler, to talk more about self-dealing and its implications on the foundations.
Thank you, Michael. And also thank you to Tom and PKFOD and Philanthropy New York for the opportunity to be able to engage with you all on this topic. As Tom mentioned, we've had the chance to present together, and it's always something that I look forward to and enjoy. So I will be covering the self-dealing aspects of both the tax return, but also private foundation law. So for the next 20 minutes or so, these are the types of things that we'll go over: the context, what is self-dealing, what are the applicable definitions and specific prohibitions underneath it, what are the exceptions to the prohibitions, which would mean that these transactions are not self-dealing when there's an exception. What are the consequences for a self-dealing transaction? And then how do you identify and prevent, get ahead of self-dealing? So the context, as Tom mentioned, the self-dealing regulations, the law and regulations are traced back to the Tax Act of 1969. Tom also mentioned that the self-dealing rules themselves do not apply to public charities. They apply exclusively to private foundations. Now, even so, public charities still have to comply with prohibitions against things like private benefit, private annulment. Compensation has to be reasonable. You can't have excess benefit transactions. So the fact that the self-dealing rules don't apply to public charities don't give public charities a free pass to not pay attention to transactions they should be paying attention to. In addition, the self-dealing rules are different from conflicts of interest. The self-dealing rules, as we'll get into, are very specific and discrete. But there may be other transactions that are not covered by self-dealing rules that are still covered by state law conflicts of interest rules, duty of loyalty, rules. So just because something, a transaction is not prohibited by the private foundation self-dealing rules, private foundations still have to deal with the duty of loyalty. They still should be managing conflicts of interest. And by the way, still should be paying attention to private benefit, private annulment, excess benefit transactions as well. The self-dealing rules are a discrete, in a lot of ways, subset of those types of things that apply. So what is self-dealing? Self-dealing was defined and put in place by Congress in 1969 in Section 4941, and it prohibits certain listed and described transactions between private foundations and their disqualified persons, whether directly or indirectly. And that latter part is important. Private foundations are not allowed to do indirectly what they cannot do directly. And that includes self-dealing transactions as well. So, for example, a foundation could not give a grant to a public charity for the public charity to then contract with a disqualified person, with an eye specifically towards that transaction. So let's talk then, break that the statutory prohibition down. When you're looking at self-dealing, the question is there a transaction between the private foundation and a disqualified person? If it's not a disqualified person, it's not going to be self-dealing. If it is a disqualified person, you then need to ask yourself, is the transaction listed in the statute or regulations as self-dealing? And we'll walk through that list. If the transaction between the foundation, or if the transaction with the foundation involves a disqualified person, the answer to 1 is yes. If it's a listed transaction, the answer to 2 is yes. Then you need to ask, does an exception apply? If an exception does apply, then it's not going to be considered a self-dealing transaction. If an exception does not apply, then you have to worry about it being self-dealing, and you need to be asking yourself these questions in advance of entering the transaction so that you don't actually then enter a transaction that's self-dealing. This has less to do with reporting on the tax return and more to do with don't do these transactions on the front end. But if you find that you've done them, then you do need to report them on the tax return. You need to begin mitigation strategies. So, first question, does the transaction involve a disqualified person? So another way, who are the disqualified persons under the law? And that's the list of folks here on A, B, C, D, and E. Essentially wanting to get into the people who have decision-making authority over the foundation and its transactions and its activities. And usually that's going to mean the officers, the board of directors, the board of trustees, if it's not a corporate entity, but it's true decision-making authority. Substantial contributors. Michael mentioned the question in Part A of this section, did anybody become a substantial contributor? Substantial contributors are disqualified persons. So the foundation can't enter transactions, listed transactions, unless there's an exception, with substantial contributors or with those who have authority. The law goes further to get to certain family members of the disqualified persons. So it's spouses of the disqualified persons, and also parents, grandparents, great-grandparents, children, grandchildren, great-grandchildren, and their spouses, which is fairly extensive and can be fairly extensive as you're trying to manage these transactions. You're trying to prevent them from happening, in the first place, but also manage by asking the right questions. But note who's not listed as disqualified person here, it's not siblings, it's not nieces and nephews, it's not aunts and uncles, unless they fall in a different category. If they are also substantial contributors, then they are disqualified persons, not under C here, but under B. The law also gets to entities controlled by disqualified persons. And here, generally it's going to be an organization that's at least 35% owned by a disqualified person. So it would be if the officer or the director or the trustee or their spouse or child owns more than 35% of a company, then that company becomes a disqualified person. And you've got to process, does the transaction involve that company? If the answer is yes, then you go to the list of transactions. That also then means, which is, this next part is part of what ought to be done from a conflict of interest management anyway. Then you need to be getting lists of these types of companies so that you can prevent the self-dealing transaction from occurring. And then even if it's not a disqualified person, you can manage the conflicts of interest. And then certain government officials, and those are fairly complicated rules. In essence, what I would say, if you've got an arrangement where you're going to be paying a government official money or paying for them to do things, go to the rules, spend some time with people who understand the details and the nuances that are more intricate than we have time to go through today. So these are the transactions. So first question, is it a disqualified person? If it is the transaction listed? That's the second question. And we'll walk through each of these along with talking about the question, does an exception apply? So because these things come together, it makes sense to talk about them together. So A, sale, exchange, or lease of property. The prohibition is on the foundation selling property to, exchanging property with, or leasing property to, or from disqualified persons. So, if the foundation has space, whether the foundation owns the space or it's leasing the space, it's got some unused space, and a disqualified person comes in and says, hey, how about if I lease this space, this unused space? The answer is no. You cannot do that because there is, the federal law says you can't do that. Public charity could do that, provided it's not an excess benefit transaction or private benefit or private annulment. But a private foundation cannot. There is no exception for the private foundation leasing property or selling or exchanging property to or with a disqualified person. There is an exception. The disqualified person can lease the property to the foundation, an office space or meeting space or whatever it might be, as long as there's no charge. So as long as a disqualified person is donating the space to the foundation, and there can't be anything like, within that transaction, the foundation is just going to pay its share of utilities or its share of property taxes or its share of something. The answer is no charge to the foundation. It's got to be purely donative. But if it is, that's an exception, again, from the disqualified person to the foundation. There's no exception for from the foundation to the disqualified person. But the other way, there can be an exception, in which case it's not a self-dealing transaction. B, furnishing or receiving goods or services. So this would be, the foundation, purchasing or receiving goods or services. if a restaurant is a disqualified person because the son of a trustee owns the restaurant, or a daughter of the trustee owns the restaurant, actually going to the foundation, going to that restaurant becomes a transaction that you've got to look at, as a self-dealing transaction, because it's purchasing goods or services. Exceptions. Does an exception apply? Reasonable compensation for employment. So I'm an employee of the Kauffman Foundation. I'm also an officer of the foundation and leader of the foundation. But it's okay for me to get paid reasonable compensation as an employee. Now, it's got to be reasonable compensation, and there are ways to go about determining reasonableness. So in our situation, we walk through that analysis. Is it a disqualified person? Yes. Is it a self-dealing transaction? Yes. Does an exception apply? Yes, it's reasonable compensation. Looking at disqualified persons providing goods or services, to the foundation for the foundation's charitable purposes, if it's donation, then it's not a self-dealing transaction. If it's purely 100% gifted, it can't be for $1 and other good and valuable consideration. The $1 means it's in exchange for value. It's got to be purely donated, and as long as it's donated. So the restaurant example, if the foundation people are going to the restaurant, and the foundation is paying for the meal, then it's a self-dealing transaction. If the foundation, if the restaurant rather is donating the meal for the foundation personnel, presumably they're having a meeting on foundation business rather than it being personal, then it's okay. Lending money or extending credit. And I can't remember if Michael or Lauren referenced that line. It might have been Lauren. In the tax return, report extensions of credit to disqualified persons. There is a prohibition on foundations extending credit or lending money to disqualified persons. It is a self-dealing transaction. It is listed, and there's no exception for the debt to go that way towards the disqualified person. There is an exception for the disqualified person to extend credit to the foundation, as long as there's no fees, there's no interest. Again, donative. You see a theme here. As long as it's donative and the funds are used for the foundation's charitable purposes. It can't be for unrelated business purposes, for instance, but for charitable purposes. A common issue that comes up here is, disqualified persons sometimes carry foundation credit cards. And as long as, which is fine. I mean, that happens, and it's a good, effective way of conducting business. The difficulty can come into play is if the disqualified person either mistakenly or intentionally uses the credit card, the foundation credit card, for a personal transaction. If it's intentional, you've got a whole different problem. But mistakes do sometimes happen, and a disqualified person might just pull the wrong card while they're getting gas. And the idea is you've got to identify that mistaken transaction as quickly as possible. The disqualified person needs to pay the foundation the value of the charge as quickly as possible, and ideally, before even the credit card bill comes in or the credit card bill is due. There are differences of opinion on whether the mistaken use of the credit card by itself constitutes a self-dealing transaction, or if getting the foundation the money, not reimbursing it even, but paying the foundation up front once the mistake is identified, if that's a self-dealing transaction. Regardless, get it paid ASAP, get it identified ASAP, and then talk with your advisor about what to do next, if anything. Here, paying, compensating, or reimbursing a disqualified person. Reimbursements for expenses incurred by the disqualified person in furtherance of the foundation's charitable purposes are fine. That's acceptable. It's an exception. Provided that the expenses are incurred in furtherance of the foundation's work and are in furtherance and are reasonable. Ideally, the disqualified person should be authorized to incur the expenses as well, not just something the disqualified person decides to do on their own. It ought to be within their sphere of authority to bind the foundation to the expense. Reasonable amount for personal services. These are things like, it's quite common for private foundations, and especially smaller ones, to have, or mid-sized ones even, to have their lawyer or their donor's lawyer, substantial contributor's lawyer or accountant, or sometimes investment advisor to be on the board. So by virtue of being on the board, they are now disqualified persons. But the foundation can still engage and get the services from that lawyer, that accountant, or that investment advisor, and other personal service providers, as long as the compensation is reasonable, and as long as the services are in furtherance of the foundation's charitable purposes and charitable mission. So there are exceptions that allow for that. It's also an exception to compensate board members to pay board fees. Most foundations don't do that, but some foundations do, and as long as the board fees are reasonable. There had in the past been some confusion about directors and officers liability insurance premiums. Those premiums are able to be paid by the foundation, with a benefit, the coverage itself, benefiting the disqualified person. But if that coverage gets invoked, there's another whole set of questions that need to be discussed and gone through. Transfer or use of foundation income. This is trying to get to, or this does get to things like, if the foundation purchases tickets to a fundraising event, is it okay for the board member, for the disqualified person, to attend the event? And the answer is yes, they can do that. Because that event, the foundation is incurring the expense, purchasing the tickets to the event, presumably in furtherance of the foundation's charitable purposes. This is not like, it's not okay for the foundation to purchase tickets to the Super Bowl and then provide the tickets to the disqualified persons. This is a fundraising event for a charity, for a grantee or prospective grantee, or just an organization that's important to the foundation. It's important for the foundation to support the organization and to be present at the organization. So presumably the board leadership, disqualified persons, are attending the event in their foundation capacity. Spouses, friends, significant others, family members, business partners of the disqualified persons, that doesn't count. The foundation can use the tickets for its internal personnel, but if a spouse or a friend goes with that person, count it as compensation paid to the disqualified person, or don't have the spouse or friend, etc., go to the event with the foundation ticket. The disqualified person can buy their own ticket or their own table for whoever else they want to go. This transfer use of foundation income or assets can come up sometimes in matching programs. Foundations will sometimes or even often match charitable contributions by disqualified persons. As long as, and these are good programs, they're worthwhile programs. The match has to be of the disqualified person's contribution, not their pledge, but their contribution. So, for instance, if I, as a disqualified person, pledge $10,000 to a charity that I support, I need to pay the $10,000, and the foundation can match the $10,000. It's not that I pay $5,000 and the foundation matches that for $5,000. In that case, my pledge is only $5,000. If the foundation's $5,000 match has to be separate than that. If I'm using that foundation paid match to cover my pledge, it is a self-dealing transaction. And you need to prevent it by ensuring that people understand the matching program and how that works and what it means, what it doesn't mean. But if there is a violation, you need to get on it right away and undo it and report it and all those sorts of things. I mentioned this again. It's fairly nuanced. If you're going to be engaging with a government official, consult with an expert on this topic, and they will help you work through it in advance so that it does not become a self-dealing transaction for them. Penalties. There are statutory financial penalties that can be imposed on the individuals, on the disqualified persons. And there's one level for the self-dealing transaction once it occurs. There's another level if you haven't corrected the transaction. And these penalties must be paid by the individual. They cannot be paid by the foundation, which makes sense because if they're paid by the foundation, it becomes another self-dealing transaction. So you don't want to complicate it. But there's also, penalties are also consequences for self-dealing transactions. Remember, this is a tax return issue on the 990 PF. You will check a box that says we had a self-dealing transaction and what type of transaction it was, and you'll need to describe it. That information is available to the public. There can be reputational consequences for self-dealing transactions. Even if you've identified it and even if you've fixed it, that can help mitigate some of the potential reputational harm. But you need to be aware of that. And sometimes, seeing self-dealing, that might be a red flag for the IRS that might result in an audit, might be a red flag for the Attorney General that could result in an audit. It might be a red flag within community, especially if the transactions are extensive. And don't underestimate the costs to remedy self-dealing transactions. Costs in terms of dollars, costs in terms of time, costs in terms of diversion from mission. So those are also part of this. So going back in some ways to the beginning, before there's a transaction, ask, does it involve a disqualified person? If it does, is the transaction listed? If the transaction is listed, then does an exception apply? If the answer is it involves a disqualified person, the transaction is listed, and there is no exception, don't do the transaction. If it's too late after the fact, the transaction has already been done, get with good legal counsel, accounting expertise to be able to figure out how to address that and move forward. Thank you for the chance to be here, and I turn it over next back to Mike.
Thank you, John. Very much appreciated. So we have a question now, CP question 6. Do you know who your foundation's disqualified partners are? A is yes, B is no, and C is, hopefully you're listening to John's presentation, who are disqualified persons again? Answer that in the polling section. While you're doing that, I'm going to move on to the next slide. So this slide really talks about, in the continuance of the page before, some items that might cause a Form 4720 to be required to be filed. Question 5 talks about how did the foundation pay or incur amounts to certain areas that might be perceived as not being allowed. Again, the IRS always has exceptions and then exceptions to the exceptions. One of the main ones we run into in the industry is question 5A4. Did the foundation give a grant to an organization that's other than charitable? And again, you could give it to a foreign entity. You could give it to a public company that's doing some sort of charitable endeavor. Again, these type of transactions are permissible. If you jump down to question 5D, does the foundation claim exemption from the penalty tax because it maintained expenditure responsibility of the grant? And that's the key important thing. You can give to these type of entities. You just have to make sure you file the expenditure responsibility rules, which require some form of documentation of how the funds were spent, just a lot more oversight to ensure that the funds actually did in fact go for charitable purposes. So this whole section kind of answers those questions, and we'll see on the following pages how expenditure responsibility kind of disclosure will look. Questions 6 and 7 are a little less. We see these less often, especially question 6 regard to premiums related to personal benefit contracts. Question 7 we'll see on some of our larger $1 billion plus foundations. There's special taxes and rules related to compensation over $1 million. So that was something that was added in 3 of the tax laws a few years ago. Moving on to part 7. This area pretty much details some information, especially compensation information about officers, directors, and highly compensated employees. Section 1 lists out all officers, directors, trustees, and foundation managers. It lists out the titles and the average devoted hours per week. One tidbit is if you have a board member that's part of a lot of different organizations, we might want to calculate and accumulate those numbers and make sure that if they're listing 60 hours on all the on their reforms, that's probably not accurate and correct. And you can see here that you list the person's name, the address. We most likely we recommend that you use the foundation's address and not their personal address, just so somebody can go online and look and see their address through a Google or whatnot. Their title, how many hours devoted per week, compensation, any contributions to defined benefit deferred compensation plans like healthcare plans, vision, 401k plans, and then any expense accounts that they may have. As you can see here, you would also list someone like an executive director or CFO, somebody who has the authority to act on behalf of the foundation, and you would list out their appropriate compensation. Then next is the compensation of 5 highest employees. Yep. Okay. So this slide shows that. Again, you would list your 5 highest paid employees, and when you calculate the top 5 highest, it includes the amount of compensation and the amount that was made to employee benefit plans and deferred compensation. So it's a total of the two numbers. You would list their titles, the average hours per week that they spent in their job. And then on the bottom here in the small letters, it said total number of other employees paid over $50,000. So if besides these top 5 people, let's say you had 17 more employees getting over $50K in compensation, you would show a nice 17 number here. And that's just letting the IRS know, how much employees and directors, officers are being compensated. This is a hot topic in their world. So we just want to make sure everything is disclosed properly and accurately. Moving on to the next page. So part 7, line 3, talks about independent contractors. When you think about independent contractors, it's not just individuals or entities that get 1099s. It's all types of independent contractors. So even the first line, it says investment management corp. That could be a corporation, organized as a corporation. A common misnomer is that only 1099 vendors are listed here, but any vendor that's paid over this $50,000 threshold should be included. And on the bottom again, in small letters, total number of others receiving over $50,000. If there were more than 5, you would list the number there as well. And when the foundation gets selected for like a workman's compensation order, something along those lines, those auditors will look at these numbers and agree to them. Moving on, direct charitable activities. This is probably one of the most important sections of the whole 990 PF, especially for foundations which are carrying on programs that are not only like grant giving programs. If you're doing, holding conferences, running some other in-house program, you would list the top 3 of those programs here. And you would provide detail. Let's say you were running a soup kitchen. You would detail how many people were served, all the good work that went into those programs. And this area really allows for kind of a brag to organizations looking to, how are you spending your philanthropic dollars? We always try to work with foundations to kind of, beef up this area and kind of, list all the good work you are in fact doing. And then on the far right, you were told the total expenses that were related to those direct charitable activities. And we're seeing more and more foundations in the industry actually move towards this, away from just giving a grant and kind of walking away. They're actually running programs within the foundation, which is perfectly permissible. And then this is just an example of what a direct charitable activity could be. In this case, they ran workshops for students, kind of described 1,000 students participated, what went on, what they learned, and then the total cost associated with that. Kind of a nice, especially if the foundation doesn't have a website, kind of just a nice place to outline what you're doing, because this is a public document. So if somebody were to look at your Form 990 PF, they can see exactly what the funds are being spent on. So it's kind of nice. Another example, seminars being held. We have a lot of foundations that utilize their office space to hold seminars. A number of individuals, and just a nice way of summing it all up. And another example here, published data. A lot of our foundations, they actually publish studies, so you would include that here as well. And then program-related investments. In this section, you would kind of detail the terms of what the program-related investment was for. You would list the top 2, and then any others you would accumulate on line 3, kind of give a broad description. But in line 1 and 2, you kind of have the ability to describe exactly what the program-related investments are for, the dollar amounts, and all the good work that they're going towards. Question 7. Does your foundation have any direct charitable activities or give out any program-related investments? A, yes. B, no. Okay. While everyone is answering that poll question, I'm going to hand it off to my colleague, Joan McCarthy, who's going to talk about minimum investment return and some qualifying distribution calculations. Take it away, Joni.
Thanks, Mike. Good afternoon, everyone. I hope you're all enjoying our presentation thus far. So I'll be walking you through the next 2 pages of the Form 990-PF. As Tom mentioned earlier, each year private foundations are required to give out at least 5% of their average assets that are not used for charitable purposes. So typically your cash and your investments. Section 9 is where we start computing this calculation. Line 1A, we include here the average monthly fair value of securities, your investments. When calculating the averages in this section, we're taking the average of the averages for the entire year. So it's not just a calculation using the average of the beginning and the ending values. It's basically the foundation's 13-month averages since the ending balance of prior year, which is the beginning balance of this current year, is also included in the calculation. Line 1B is where we include the average of the foundation's cash. Line 1C, this is the fair value of all other assets, typically your real estate, royalties, any other less liquid assets. Foundations must value these assets annually, with the exception of real estate, which can be valued every 5 years. Line 1D is the sum of all of the averages. So in this example, we have $78 million. Line 1E, it's the reduction claimed for blockage or other factors. This is typically, we usually see this completed with our artist endowed foundations for the blockage of the artwork. And then under private foundation tax law, there are a few other adjustments that we need to consider. For example, line 4, the IRS is kind enough to allow us to deduct 1.5%, which they deemed for administrative purposes. Line 6, we take the 5% of that $77 million listed above on line 5, which in this example is $3.8 million. And this $3.8 million is the foundation's 5% minimum investment return. So moving on to part 10, the distributable amount. So the distributable amount for 2023 is the amount that the foundation must distribute by the end of 2024, the following tax year, as qualified distributions in order to avoid paying the 30% tax penalty on the undistributed portion. So with this calculation, we're going to start with the foundation's minimum investment return amount of $3.8 million from the previous slide. And then we have a few more adjustments that we'll need to incorporate. The IRS allows us to deduct taxes that the foundation already paid during the year, which is the $78,000 on line 2A. And this amount was also taken directly from page 3, part 5. If you had any unrelated business income tax, also known as UBIT, during the year, this would be listed on line 2B. Moving on to line 4. This is where we would add back any recoveries treated as qualifying distributions. This is typically your grant refunds or PRIs. In this example, it's a PRI of $250,000. So anytime a PRI is given out, the foundation has the benefit of taking it as a qualifying distribution. And if in this case, if you get a PRI back, you have to add that PRI amount to this line item. Line 7 is the distributable amount And in this example, it totals around $4 million. So after all of the additional adjustments that we just went through, this $4 million is the final amount that the foundation is required to give out. Moving on to the next slide. So now that we know what the foundation has to give out, let's figure out how much they actually gave out. And this is where we will do that. So the $4.7 million on line 1A is being pulled from page 1, part 1, the total of column D, which is the foundation's disbursements for charitable purposes. And then, of course, we have some more adjustments. As Mike just mentioned, the foundation also gave out a PRI of $750,000 during the year, which, as we mentioned before, the foundation is able to count this PRI towards their qualifying distributions. Line 2, Tom covered this a little bit earlier, but if the foundation acquired an asset like furniture or equipment, this would be listed here. And as Tom mentioned, depreciation is not allowed in column D on page 1. And this is because you're allowed to take the full benefit the year that you actually purchased that asset or equipment. So the full amount of that asset would count towards your qualifying distributions and will be listed on line 2. Line 3 is where we would list any set-asides. These set-asides usually require prior authorization from the IRS. These would also increase your qualifying distributions. So after all of these adjustments are made, we get to our qualifying distribution amount of $5.5 million. So let's quickly recap this page before moving on. We now know that the foundation gave out $5.5 million. They were only required to give out $4 million. So now we know that the foundation's in good shape and they're paid in. Moving on to the next slide. Part 12 is where all of this comes together. It may seem a little bit repetitive. I'm going to be using similar numbers and amounts from the previous page. So line 1, column D, is the amount that we are required to pay out, which is the $4 million from the previous slide. Line 2A, if the foundation had an amount that was undistributed in the previous year, so in this case 2022, that amount would be listed here in column C. But just remember that the IRS allows you until the end of the following tax year to meet your required minimum distribution payout. Line 2B, if you had any undistributed income in years prior to 2022, these amounts would be listed here in column B. And just remember that this is the amount that's subject to the 30% excise tax penalty. So you always want to keep that line in mind. Moving on to line 3. Line 3 shows us the breakout of the excess distributions carried over from previous years. So when we see excess distributions, we know that this foundation went above and beyond the required distribution amount. So foundations are allowed to carry these excess distributions over for 5 years. This is a rolling 5 years. So in this example, if the foundation didn't use the $40,000 from 2018, it won't be carried forward to next year's tax return. So the total carry forward for 2023 in this example totals around $2.4 million. Line 4 is the qualifying distributions that we calculated on the previous page of the $5.5 million. So if the foundation didn't meet last year's distribution requirement, the qualifying distributions would be listed first on line 4A in column C to satisfy prior year. And then any remaining amount would be counted towards satisfying the current year. In this case, it's 0 because the foundation gave out more than they needed to. Line 4E is the remaining amount distributed out of corpus. This is simply just the difference between the qualifying distribution amount of $5.5 million that was given out and the required distribution amount of $4 million, which in this example leaves us with $1.4 million. So this $1.4 million will be carried forward and applied to next year's tax return, which you'll see on the next slide. So moving on to the bottom of page 9. Line 6F is the undistributed income for the current year. Luckily for this example, the foundation is not underpaid, so it's 0. But if there was an amount listed in 6F, the foundation would have to pay that amount by the end of the following tax year. So this is always a really important line item to pay attention to. And then on line 9, we see the total excess distribution carryover that will be applied to next year's tax return. Lines 10A through E provide you with the detail of line 9. And here you'll see that 2018's excess distributions are removed and current years have been added because it's a 5-year rolling carry forward. One last thing for me to note is that this page and also part 12 will not be completed if your foundation is a private operating foundation. Instead, private operating foundations will complete a different calculation, which Jason is about to bring you through over the next few slides. And it looks like we have a polling question. What type of private foundation is your organization? Non-operating or operating? Thank you. Jason, take it away.
Thank you, Joan, for taking us through calculating the minimum distribution requirement for a non-operating private foundation. As Joan mentioned, the next few slides that I'll be going over are related more towards private operating foundations and their distribution requirement. While page 9, what Joan just went through, is often the most misunderstood page for private non-operating foundations, the top of page 10 is probably the most misunderstood page for private operating foundations. So throughout this presentation thus far, we've really only alluded to private operating foundations, and we really think that it wouldn't do us justice if we just didn't mention them at all. So we are going to go over an example of a private operating foundation. And so we're really just taking a sidebar. We're disregarding our previous example, and we're going to be looking at a completely separate example of how a return of a private operating foundation would look like. But before we do so, just to really look at the private operating foundation page for a non-operating foundation, this page would be marked as not applicable and really just left blank. And as you can see on the slide, that's how it's been presented. So now let's take a step back. There really are 2 types of private foundations: those that make grants, contributions, etc., for qualifying 501c3 purposes. And these would really include your typical private non-operating foundation. And the other type are those that are really engaged directly in the active conduct of programs and other activities. And these are your private operating foundations. Some foundations do take on a hybrid approach, giving grants and operating programs. But when we really speak of private operating foundations, we're really talking about those organizations whose primary focus is on grants, is on programs and activities instead of grants. They may give out a few grants or to no grants at all per year. But again, their primary focus is on programs and activities. And as we'll see, this is because grants do not count towards a private operating foundation's distribution requirement. And let me just take one step back there. While generally grants do not count towards a private operating foundation's distribution requirement, there are instances where you can count grants towards that requirement. We're not going to go into significant detail on this, but as one example, if you had a program where you're giving subsistence grants to to individuals that in need, or disaster relief grants to individuals, as long as you maintain a significant involvement in that, you can count those grants. So if you were to giving subsistence grants to individuals, and you had a social worker on staff, and that social worker was actively involved in monitoring those grantees and how they use those funds, and working with them, and really just getting into the nitty gritty, those subsistence grants would count. So that's just one example, but I won't go into really any significant detail other than that. Again, before we get into the actual return, there are benefits and drawbacks to private operating foundation status, but depending upon the mission of the organization and how it wants to accomplish that mission, the status may be a more logical approach than non-operating foundation status. Some of those benefits to qualifying as a private operating foundation include, private operating foundations are not subject to the income distribution requirement and related excise tax on failure to distribute that a non-operating foundation is subject to. So that whole calculation that Joan went through, private operating foundation will not calculate that. They're not subject to that particular test. Another benefit is that donors to private operating foundations are typically subject to a 50% charitable contribution deduction versus a 30% to a non-operating foundation. So definitely a benefit to your donors if you have living donors, or if you're currently still soliciting funds from the public or individuals. Definitely a benefit to them there. If you're operating as a private operating foundation. Another benefit is that a non-operating foundation may make qualifying distributions, i.e. those grants, to private operating foundations without the restrictions that will apply to when making similar distributions to another non-operating foundation. So if one non-operating foundation gives to another non-operating foundation, there's expenditure responsibility, and then also what we would say is you would have to take, only one of those foundations can ultimately take the contribution, and you would have to take what's called an out of corpus election. But in the case of a non-operating foundation giving to a private operating foundation, that requirement's not included. Another benefit, certain private operating foundations, if meeting a certain set of specific criteria, are exempt from the net investment income tax. So these organizations are often referred to as exempt operating foundations. And again, these exempt operating foundations, they act very, very similar to public charities, and therefore that's why there's that exception that you're not subject to the net investment income excise tax. But again, could be a benefit if you were to look into how that qualifies, how you would qualify for such. And lastly, specific to private operating foundations, private operating foundations are treated as public charities rather than private foundations for estate and gift tax purposes with respect to certain transactions involving works of art. So your artist endowed foundations are often set up as a private operating foundation because of this rule that they're treated as public charities instead of as a private foundation for those estate and gift tax purposes. So those are some of the benefits. Some of the drawbacks here, just to name a few, is that the private operating foundation status is very, very complex when meeting the distribution requirement tests, as we'll see on the next couple of slides. And the need to really continuously monitor those tests it adds to the complexity. So those are some of the drawbacks. So now let's really just move on to the next slide. And this is where we're going to start to describe some of those distribution requirement tests. So How do you qualify as a private operating foundation? Well, you really have to meet two tests. The first test is the income test, and then you also have to meet one of three alternative tests, either the assets test, the endowment test, or the support test. Just to describe the income test, in order to satisfy the income test, the organization has to meet qualifying distributions directly for active conduct of its exempt activities. Remembering that grants typically do not count towards that. And you have and those qualifying distributions have to equal substantially all, which in the IRS, terms means 85% of the lesser of its adjusted net income or its minimum investment return. If I've lost you so far, don't worry. Hopefully, when we go through the example, you'll have more clarity as to this. And while Joan kind of went over how we calculate the minimum investment return, I just want to briefly describe how we calculate the adjusted net income amount. And that was really, going back to what Tom said on page 1. The adjusted net income calculation is included in column C on page 1. And in this example, we've completed column C. Again, please disregard the prior example, as this is a completely separate example. But we've completed column C as though the foundation is a private operating foundation and not merely a non-operating foundation. You can see that we've included all interest and dividends, short-term only, realized gains, and all other investment income, and any program service revenues. These are the typical items, income items that we see. There are a few income modification provisions in calculating adjusted net income, but really those are outside of the scope of this presentation, and we won't go into too much detail there. But these are the typical items that we do see. Especially just, again, mentioning one item is that you disregard any long-term realized gains and only include short-term gains. Similar to column B, you can take losses in this, net losses in this column. You can net realized gains and losses, but as long as you have a net realized gain, you would include that amount here. If there was a net realized loss, it would be 0. Okay. So moving to the next slide, we see the bottom of page 1 completed. Again, just focusing on column C here. You're able to take any reasonable, direct, and allocable expenses against the revenue items. One item to note here and to remember is that each revenue generating activity should be siloed. Meaning if you have a program that generates $10,000 of income and it incurs expenses of $15,000, and often these programs do run at a loss, only the $10,000 of expenses would be netted against the income and included in column C here. The remaining $5,000 would be included in column D as a disbursement for charitable purposes. If you had investment expenses that exceeded investment income, those expenses would be limited to the investment income and really not included in column D, as those are not for charitable purposes. Okay, so just remembering, again, siloing those activities and including the proper expenses in the proper column is very important. So now that we have a basic understanding of how adjusted net income and the minimum investment return is calculated, again, the minimum investment return was discussed by Joan. We'll go on to the next slide where we find the private operating foundation tests. We're going to focus really on lines 2A through 2E, where we find the income test here. This is where we would take the lesser of adjusted net income, again, calculated on page 1, part 1, column C, and the minimum investment return that was calculated on page 8, part 9, line 6, again, that Joan went over. And then line 2B, we take 85% of that. This is really the number to beat for the income tax test. Lines 2C through E takes the qualifying distributions and then subtracts out any amounts that are not directly used for the active conduct of your exempt activities, i.e., certain grants, grant administrative expenses, and some portion of other administrative expenses. So, when calculating this, it's very important to really document your methodology of allocating expenses between your different activities. If you do have a grant, a small grants program, any grant managers or any of that type of activity should not really go towards satisfying this test, as that's really not in conducting your active programs. But if you have an executive director that monitors, your grants program, and they monitor the program, your other programs, allocating those salaries and those types of expenses, again, very important. You want to have a reasonable basis for those allocations. You want to have documentation and to really satisfy this test. Okay, so if lines 2E is greater than line 2B, you satisfy the income test. You've passed that test. Now, unfortunately, we don't really have too much time to go into the, to detail of the alternative tests, but if you satisfy the income test, that's one test, and then you have to satisfy one of the alternative tests, which include those listed right below in the lines 3 and so forth down. I'll briefly describe each test, but again, we don't have too much time to go into detail. In meeting the assets alternative test, the assets used or held in the active conduct of exempt activities must be at least 65% of all assets held by the foundation. Typically, this test is met by your museums or your artist-endowed foundations that have significant artwork versus having cash and investments on hand. In meeting the endowment alternative test, qualifying distributions, again, line 2E, must be greater than 2/3 of the minimum investment return. This is usually easier or more easier than the other two tests to meet. And we often see this test being completed versus the others. But really, if the foundation had significant portions of its assets as investments, and therefore not in the active conduct of activities, using this test is primarily the go-to test for those types of entities. And lastly, in meeting the support alternative test, you have to meet 3 criteria: at least 85%, at least 85% of the support other than gross income is received from the general public and from 5 or more exempt organizations. Not more than 25% of its support is received from any one exempt organization, and not more than 50% of total support is received from gross investment income. Now that we have a very basic understanding of the test, you may be asking, why are there 4 years of data here? Well, you can meet the tests in either the current year or in the aggregate over a 4-year period. This helps if the foundation has 1 year or 1 or more years where it ramps up spending, and then a year where there is a pause or slowdown in qualifying distributions. Where a private operating foundation may switch between tests in any particular year, if it needs to meet the tests in aggregation, it must meet the same test for all 4 years. So, if in 2022 you met the endowment test, but then in 2023 you had to switch to the assets test to meet the criteria, you could do so, but in the aggregation method, you would have to meet that specific test in the aggregate over the 4 years, and therefore couldn't really necessarily switch between the tests. So as these tests and calculations are rather complex, we highly recommend that if you are a private operating foundation, that you constantly work with your tax preparers throughout the year to help build models of the tests using budgeted amounts to really forecast whether the foundation will meet the requirements. If a operating foundation was to fail to meet the tests, it would revert to a non-operating foundation. Not the end of the world, but you would have to meet the minimum distribution of a non-operating foundation in that year. And if it failed to meet that test of a non-operating foundation, so if you failed the test and failed the test, then you'd be subject to the excise tax on failure to distribute. So again, not the end of the world, as long as you met the distribution requirement for a non-operating foundation. And then in the following year, you could then calculate the tests again and get your get your status back as a private operating foundation. Before we move on to the next section of the return, just one item we typically see with private operating foundations is that a private non-operating foundation sometimes has activities that it doesn't necessarily want to happen in that private non-operating foundation, and they often spin off certain assets or certain activities to a private operating foundation. We see this a lot with side-by-side foundations, and could be an option for you if in satisfying your mission you needed to do that that separate activity. So now we're going to go back to our original example. We're going to disregard the private operating foundation and really focus more on our previous example. And we're going to talk about the supplementary information sections of the return, beginning on the bottom of page 10, continuing on to page 11. The bottom of page 10 includes 3 questions. The first question really pertains to your foundation managers who have contributed 2% of the total contributions received by the foundation before the close of any tax year since the foundation's inception. These are your substantial contributors that are also foundation managers. That's required to be detailed here, just the names of those foundation managers. And on the next slide, we'll see statement 16, which kind of details that. Line 1B lists the managers of the foundation who own 10% or more of the stock of a corporation or a similar or equal portion of ownership of a partnership or other entity, which the foundation also has a 10% or greater interest. Really, it's not apparent as to why these questions are asked by the IRS, as really this detail is included elsewhere on the return. Your foundation managers your foundation managers are disqualified persons. So whether they're substantial contributors or not doesn't really change anything. And similarly, question 1B, that's also included on other parts of the return where if you have significant ownership in a corporation or partnership or other similar organization, that would be required to be listed. But nevertheless, these questions are included on the return and have to be answered. Question 2 is a very important question. And Tom often, tells foundations, and we often recommend our foundations, unless you have programs where you're actively soliciting, information from the general public as to, whether they've required grants or contributions, unless you really have that need to ask, potential grantees for information, including the check in the box here, will limit, hopefully, some of the requests that you get through mail or through email from unsolicited, potential grantees. Although you may check this box, you can still get requests. It's not really a stop all. There are mailing lists out there, or again, as Tom mentioned, this return the return is public knowledge. It is public document. So any individual or any potential grantee can always search your for your form and obtain your address from page one, and ultimately send you a solicitation for a grant. But by marking this box as that you do not accept unsolicited requests, can help to stymie some of those requests. If instead you do have programs that you want to get solicitations from, including the name, the address, the telephone number, or the email address of the person to whom applications should be addressed, should be included here. Any any submission deadlines or any restrictions or limitations can be included here. If you do have multiple programs that are separate, maybe you have a scholarship program, and maybe you have some other program that you want to get the information, including multiple statements is allowed, and you can document, if you have different individuals monitoring those programs, you can have different emails, etc., different deadlines, different application processes, or whether there are any restrictions or limitations. Moving to the next slide. Again, as I mentioned, listing the foundation managers who are also substantial contributors is required, and this is a sample of that statement. The next slide is really the top of page 11 of the return. This is where you're required to list out all of your grantees, those paid during the year, and if you have any approved grants during the year, but those haven't been paid as of the end of the year, the bottom of page 10 would include a list of those. You do have to include the grantee's name, the address, whether there's any relationship with any foundation manager. You would have to list that relationship here. The status of the recipient. And this is a very important column because it really tells the reader whether, there may be expenditure responsibility required of a particular grant. You'll see that there's multiple codes listed in this column. We have NC, which is not otherwise classified, meaning it's not a public charity. It isn't a private foundation. It is a private operating foundation. A code of NC would most likely need expenditure responsibility. Other codes, if you have a government entity such as a school board or a school council that you give grants to, that might fall under the Gov distinction. If you have public charities, you list those as PC. If you give to another private foundation, you would list as PF, and that would also need expenditure responsibility. The code of EOF is your exempt operating foundations. Those do not require expenditure responsibility. So including the right code in this column is very important. In the next column is the purpose of the grant or the contribution. It's important to really detail out the purpose. You cannot just include the words that it's for charitable purposes or charitable nature. You should include some sort of description here. If it's for general operating expenses, that's also acceptable to include here. But this can also help to really highlight the foundation's mission. What is it actively involved in? What type of grants does it give out? And then lastly, the last column is the amount of the grant. As mentioned, the bottom of page 11 includes those grants approved for future payment but not yet paid. You would list those here. In our case, we're on a modified cash basis, and the foundation did not approve any grants for future years. Okay. Next, we have a polling question. Does your foundation make grants to non-public charities or foreign grantees? Yes or no? Page 12 of the return includes an analysis of income-producing activities. The most important columns really here, and much of this information really repeats from from page 1 of the return, but the most important column here is your columns A and B, your unrelated business income columns. If the foundation did have any unrelated business income activities or generated unrelated business income activities through a limited partnership or anything of that nature, you would include that information here, and ultimately that information would mirror what's on the 990T. Columns C and D are amounts that are excluded by sections 512, 13, or 14. This is typically your net investment income amounts, your interest, dividends, any other investment income, your realized gains and losses on sales of investments. And then column E is your related or exempt function income. This would include your if you were to hold a seminar and you would charge a small fee to attend those seminars, that income would be included here. If you had interest from program-related investments, that would also be included here. And any tax-exempt income would also be included here. So your state and municipal bonds, that's the $32,000 that's listed on line 4. You are also required, if you do list any items in column E, that you do describe how those income amounts really relate to your programs, other than they produce income and that income is used for other charitable purposes. So we do see some descriptions here. Line 1C, the foundation conducted 2 educational seminars, and they charge $25 per person to help defray the cost of hosting the seminars. So that's detailed on the bottom of this page 12. We also see, the state and municipal bond interest that's excluded from gross income, and therefore it's included in column E. And also interest on loans to engineering firms. If we go back to our example of PRIs that Mike went through, that's included there as well. And now we really move on to the last page of the return, page 13. The top of the page includes information regarding transfers to and transactions and relationships with non-charitable exempt organizations. So what exactly are these non-charitable exempt organizations? Well, anything other than a 501c3 organization. So these non-charitable exempt organizations are not your public charities, they're not your private foundations or exempt private foundations. Rather, if you gave money or had some sort of transaction or relationship with a 501c7, which is your private clubs, or 501c6, which includes organizations such as your chambers of commerce. Some others might include, your veteran organizations. Those are your 501c19s. So any type of transaction with entities other than your 501c3s, or, and this again is getting a little technical in detail, but any organization in Section 527 relating to political organizations. Okay. So we do include some detail here. The foundation did have transactions with a club, a private club, and also a chamber of commerce. So we detail that there. And on the next slide, we include a statement of how we include a statement as to how or what type of activities or description of the transactions were made. So, for example, the U.S. College Club of New York, a private club, the foundation did rent facilities and equipment from them for one of their seminars, therefore it's listed. And the Chamber of Commerce, there was membership fees, and that was pertaining really to networking events available to members as the foundation wanted to stay part of the community. Okay. Question 2A and 2B relate to relationships with those non-charitable exempt organizations. So if you work together with any of those organizations, or you shared facilities, or you had common control, depending upon certain criteria, you may need to list those organizations, the type of organization, and a description of the relationship. And then the very bottom of page 13 is the signature section. And this section has really gone by the wayside per se, because there's a separate form, a form 8879TE, which acts more as the signature page for electronic filing returns. But nevertheless, the information should be presented here. You want to list, the title of whoever is signing the return, whether the IRS can discuss the return with your tax preparers, as well as the name of the tax preparer, the firm name, whether that individual is self-employed or employed by a firm, and the firm's information, their address and phone number. So that brings us through the return. I am now going to pass this on to Anand, who will include a few items that we've already discussed, but definitely worth highlighting further. Anand?
Well, thank you, Jason. Nice job in the operating foundation compliance and rules. They could be very convoluted, and I think we could probably spend a day on specific rules related to operating foundations. We do have about 15 minutes left. I want to allow some time for Q&A. The next few slides, we went through, our team has gone through the 990PF page by page. We'll spend a little time on some of the common errors that we see when we're looking at some 990PFs. Some of these have already been really kind of touched on briefly. I'm not going to go one by one, but I'll touch on the most common errors. With that said, I'll go page by page. Looking at the 990PF page 1, one of the errors we see sometimes is accounting method. Tom Blaney touched on accounting method and what it means. A lot of times what we notice, the accounting method that is indicated on the 990PF is not in line with what the foundation keeps its books and records on. So it could be an accrual basis on the 990PF, meanwhile it's a modified cash basis on their financial statements. It's important that those two, that they're aligned, and also it really lessens the administrative burden on a foundation reconciling the two documents. Another thing I think we noticed also, cash basis may be checked on page 1. However, when we look at the balance sheet, there are liabilities, there are prepaids, and other assets. So it's really an accrual basis. So again, it's important to make sure the foundation follows, one, the books and records that they maintain, but also the method of accounting that is indicated on page 1 throughout the remainder of the return. Another item I think on page 1 that we see, a common error is column C. Jason touched on column C. Generally speaking, column C should not be completed by other than operating foundations. A lot of times, a tax preparer that may not be familiar with private foundations may complete that part, just not knowing enough about the private foundations, where they would mirror the numbers in column B in column C. It just really creates confusions, and sometimes it may raise a red flag with the IRS. Very important column also is column D. Tom touched on column D and what column D is. Column D, IRS is pretty clear, and the top of the column indicates it must be completed on a cash basis. A lot of times we see it's not on a cash basis. It's important, IRS is pretty clear that any disbursements that count as qualifying distributions, they need to be cash out the door. Couple items related to column D, generally speaking, all expenses the foundation incurs for exception of investment income would be counted as qualifying distributions. A lot of times we see expenses that can be counted as qualifying distributions left out of column D. So ultimately that would hurt the foundation in meeting those distribution requirements. Moving on to the next slide. This, not really want to see this too much, but there are times where foundations may receive in-kind contributions or some sort of pro bono goods and services. Although this is important for GAAP financial statements to record this in-kind transactions as income and expense. However, for IRS purposes, they should be left off the 990 PF. A lot of times we'll see it where the tax preparer may actually include those numbers. Moving on to part 1, line 15. Tom mentioned the excise tax, and that is omitted from column D. Another area we see a lot of mistake being made, if there's any payroll taxes, the foundation's portion of payroll tax. We see that sometimes picked up on line 18. Line 18 is reserved for excise tax, foreign taxes, maybe real estate taxes. Any taxes related to payroll, generally speaking, should be in line 15 with pension plans, employee benefit expenses. On the next page, on page 2, a lot of times when we look at 990 PF, that is again being prepared by a preparer that may not be familiar with the form. The IRS is pretty clear in terms of what is required when you disclose a foundation's investments, right? We see a lot of times where it's just a summary line, investment, and the total dollar amounts. The IRS now requires, or has always required, a detailed list of every investment the foundation is in. The number of shares, description, meaning the name of the investment, the book value, and the fair market value. This would raise a red flag if it's not presented this way, and it may be considered an incomplete return if it's not filed and disclosed properly. The next item here I'm going to discuss is on page 3, capital gains, where this is really the opposite, where we see a lot of foundations sometimes provide too much information, right? Especially specifically to capital gains or losses that are generated on publicly traded securities. There, the IRS just really wants a summary of any gains or losses that are attributable or related to publicly traded securities. Another item I think it's important to note for many of you, there are, throughout the years, or there may be some sort of amendment to the government governing documents or instruments of foundation, whether it's the articles of incorporations or bylaws. Right? It's very important. This is disclosure a lot of times is overlooked. When there is such an amendment, the IRS has to be notified. There's a box in the IRS that you check yes, and you're also required to attach those amendments. Moving on to page 5. John did an amazing job going through self-dealing rules. I think a lot of times we may see a foundation check the box and not follow through, which meaning follow through reporting that self-dealing and possibly filing a 4720. Another area I think of consideration when we're looking at 990 PF, so when you're reviewing all 990 PF, we touched on some of the summary of direct charitable activities. As I said earlier, this is really a marketing tool. when you really a foundation talks about what it does, other than just making grants, right? Mike touched on a little on this. Tom Blaney did as well. This is an opportunity where foundation talks about other dollars it is spending on grantees, whether it's conferences, webinars, just really educating the grantees and spending dollars to meet its mission as well. On page 8, we spend a lot of time. Joan did a great job going through page 8. 2 items here that are very important. We see some common errors. Recoveries of amounts that were treated as qualifying distributions in the past. This is where a foundation may receive a grant refund, or if in the past the foundation made a PRI, the PRI is paid back to the foundation. It's very important that foundations treat those as recoveries, meaning they counted as qualifying distributions when they went out the door, but when they come back, they got to be treated as recoveries, and in that specific year, go back as in undistributable income. And lastly, I do want to save some time for Q&A. Qualifying distributions, when a foundation does purchase property and equipment that is specifically or used for the charitable purpose of the foundation, those do count as qualifying distributions in the year those expenditures are made. So very important, and those dollar amounts could be substantial for many foundations. So whether a foundation buys a building or renovates its office space, again, these are dollars that do count as qualifying distributions. With that said, I want to pause here. I want to turn it back to Michael Koenig, who will walk us through any questions that have come in throughout the session. Mike?
Thanks. Good, quite number of questions. So I want to make sure we hit some of the larger ones. And if we don't respond to you, we'll be following up with an email. Let me see. First one is probably for either Tom or Anand. Can staff salaries be reported outside the 990 PF? We have staff every year that are distressed when everybody's salaries are reported publicly.
I can grab that one. If you'd like. Technically, on a 990 PF, the 5 highest staff, or the 5 highest, there's 2 categories: 5 highest staff or 5 highest disqualified persons, which would be trustees and, let's say, CEOs, CFOs, etc., whose compensation is over $50,000, must be disclosed. Ironically, if it was at 990, it's over $100,000. For employees, at least. The problem, if you don't disclose it, you're really opening yourself up to an incomplete return, and the statute of limitations does not apply. So unfortunately, it has to be disclosed. We know we have a similar question with our larger foundations that are into certain private equity investments. They do not want to disclose to the general public which private equity investments they may be in. But again, technically in that area, if you don't disclose the actual name of the actual alternative investment, the IRS could come in and then claim that was also an incomplete return.
Perfect. Thank you, Tom. Next 2 questions for related to John Tyler. John, can a foundation rent office space from a disqualified person?
So a foundation can use a disqualified person's office space as long as the space is donated from the disqualified person to the foundation. So it's fine for the foundation to use the space, but they shouldn't be paying anything to the disqualified person for the space. It's got to be donated.
Thank you, John. One more question for you came through. Mm-hmm. I know we can pay directors and employees, but how do you determine what is reasonable compensation?
So, reasonableness for public charities, there is, the rebuttable presumption of reasonableness. And there's a process for doing that involving getting a third party with expertise in compensation who does a market analysis, identifying comparable organizations, comparable positions, and then from that, identifying ranges that can be appropriate, and then placing compensation within the ranges. That rebuttable presumption only applies for public charities. However, the process that is laid out, and I think it's in 4958, Tom would know off the top of his head. Michael, you may know too. The process that is used in the rebuttable presumption for public charities is still a good process for comparing and understanding the compensation paid within a private foundation. You just don't get the presumption that it's reasonable. That being said, it's a good process to go through.
Mm-hmm. Thank you, John. Mm-hmm. Okay. A few more questions open to the floor. Are there any additional requirements or disclosures that need to be made if grants are made, if to make hardship grants to individuals?
Sorry about that, Jason. Jason and I actually just worked on a similar project. Jason, you want to just maybe elaborate a little more on that?
Absolutely, Anand. So, unlike your grants to individuals where it's for travel or study or other similar purposes, those you need to get prior written approval from the IRS for those type of programs. If it's for a hardship grant, or if it's for disaster relief for individuals, those do not have to go through and obtain prior written approval from the IRS. But nevertheless, you always want to document how those individuals do meet your criteria for, hardship grants. What's a hardship grant? You want to have a clear definition of that, and that type of that type of documentation.
Perfect. Thank you, Jason. We are running out of time.
Yep.
So
I want to take it away.
Sure. Before I turn it back to Harleen, I just want to we want to take the opportunity to thank you all for attending and join us here today. We hope you found this to be an informative and helpful workshop. We, of course, want to also thank Philanthropy New York for their collaboration with us on this event. And, of course, our speakers. And a special thank you to our guest speaker, John Tyler. And, of course, the marketing department, for doing a great job putting this together. For those of you who submitted questions that we're unable to get to, someone from our team will be reaching out to you. And also important to note, this recording of this workshop and the slides will be available on our website within the next couple of days. So truly, it's been a pleasure being with you all today. Thank you all and enjoy the rest of the day. Pauline?